Are you live? All right, live.
Episode 10.
Episode 10. We're here, baby.
We are here.
We're here. The
They didn't think we would
long-awaited
make it
episode.
here, but God did. God did.
Nah, for sure, for sure. Like when we started, it was like, okay, this is definitely one of those milestones that, okay, if we get to episode 10, all right, we know we're doing something. One, because like, all right, we're doing it because people are obviously listening to us, and then they're also getting some type of like benefit from listening to it. So definitely a milestone for us.
Definitely an accomplishment for sure. Who would have thought we'd get to episode 10? I mean, like you said, when we started, it was definitely iffy. We was trying to get to episode 3. And now we got to 10. Now we're actual podcasters.
Yeah, I guess we can add podcasters to our title now, to our many hats.
I like to call myself a speaker, not a podcaster.
All right, big man.
I'm a speaker. But shout out to everybody that's been listening to us, supporting us along our journey. And, I would like to acknowledge the hate listeners. You guys are important too.
I mean, I like to think we don't have haters, but I mean, if you say so.
I mean, we probably don't have haters yet, so we got to get more popping.
If we end up popping, I mean, y'all can just hate on Dami. I don't need any more haters. Y'all just hate on Dami. He got it.
I feed off the hate.
Oh my goodness. But what would you say that, I guess, this journey leading up from episode 1 to episode 10 now has, I guess, taught you about yourself, or just making content in general, making this podcast?
I definitely have a newfound respect for content creators. It's not an easy thing at all, but yeah, we do it. I mean, just from creating the content, thinking about the content, putting the content out, standing in front of a camera, talking and recording yourself. There's just so many things I've learned, and I got respect for content creators, and it's not an easy thing. It's basically a full-time, part-time gig for sure.
I mean, no, like when people say they're like full-time content creators, like, I mean, I can see, like, if you're putting content out like consistently, like it's
Yeah,
a
facts.
full-time job, like having to edit, having to game plan what your content is going to be about, editing the videos, making sure everything looks good, posting on all the different platforms. Like
Facts.
it's not a joke at all. But
Facts.
nah, that's a good one. That's a good one.
What about you? I mean, you're already a content creator, but anything from you, at least as a podcaster now?
I'll say for me, it's being comfortable with being uncomfortable. I'll say like that's the biggest thing for me. Like I'm not someone that necessarily like likes to talk in front of the camera or just talk about things in general. I like pretty much like what Damien said, like I make content, but I don't really talk in my content. I just make workout videos and stuff like that. But I think with this, it's made me more comfortable with like expressing myself or just having conversations. Like, yeah, like I have thoughts in my head. It's cool. Like people want to hear those thoughts as well. So it just made me more comfortable with doing that. And then also like the time management of it, like trying to balance making like fitness workouts and then going to the gym, but as well making content for Common Sense as well. So, just a
Yes,
balance.
man. Sacrifice for the podcast.
That's it, man. That's it. Trying to figure this out, balancing everything, seeing what needs to be cut out, being more efficient with my timing, all of that put together. But I'll say that's one thing. Those are the major things that just this journey from episode 1 to episode 10 has taught me for sure.
I'll say one other thing I'll add is it's made me a lot more efficient because you got to find the time to do stuff. So the way I use my day now is so different than how my day used to be before the podcast. So
you legit have to like time block time in your schedule to be like, okay, I want to do this at this point in time and stuff like
for
that.
sure.
But nah, I mean, I'm glad we're here. This is to 10 more episodes. We're going to come back episode 20, episode 50, episode 100. Common Sense is here to stay.
Thanks to you guys.
All right. With that, I guess we can get into today's episode. So welcome to episode 10 of Common Sense Pod, where we are documenting our journey as two first-generation Nigerian-American millennials trying to figure it out financially. And hopefully, we can all learn a thing or two as we embark on this journey and share our experiences. I'm your host, Umar, and with me is my co-host, Dami. Before we get into the episode, make sure you follow, subscribe to the podcast so you never miss an episode. Like, comment, and share with someone you care about is one of the ways you can support this podcast and it also lets us know what you like and helps us create this content that you come to enjoy.
Turn your notifications on too, because we don't have a set posting schedule yet.
All right, with that, let's get into today's episode. So if you've been following the journey, on episode 2, we talked about investing for beginners. Pretty much what we talked about was why you should invest, what you should invest in, and how you can get started with investing. And now at episode 10, we want to talk about investing for beginners part 2. Pretty much what we're going to go over is, okay, now that you've hopefully started your investing journey, what exactly should you invest in? Like what exactly should you invest in? Like the actual assets that can make you money over the long period of time. And then how do you know if it's a good investment or not? The reason why we want to touch on this topic is because we realize that a lot of people struggle at this point in time because one, there's a lot of information out there. People don't really know what exactly they can invest in, what's a good stock to invest in, because there's just a lot of information of people saying this is a good company, this has a good rate of return, but not really deep diving into why it is a good investment for people to do. And so that's some of the things that we want to talk about today. Another thing is that people are scared to lose their hard-earned money. Obviously, you work hard for your money, so you don't want to lose it. And so if you have that fear of losing your money, 9 times out of 10, you're not even going to take that investing step. And so for us to help you with that fear, so you have more information as to what you should invest in, that's pretty much why we're going to talk about this today for our listeners. And so with that being said, Dami, what would you say some of the things that people can invest in today?
Great. So like Umar said, we mentioned this a little bit in episode 2. So we're going to get a little bit more in depth. For the sake of this episode, we're kind of going to focus more a little bit just on stocks and ETFs, but I'll talk about all the things briefly. So you can invest in stocks, which basically is you purchasing a piece of a company. You purchase shares so that you can own a part of the company. You buy the shares of a company, and as the company increases in value, then the shares also increase in value. So increasing the value of your asset overall. So then we have ETFs and index funds. ETFs and index funds are basically a compilation of good companies put together by someone. So for example, Umar might decide he wants to put together an index fund or an ETF based on stocks he thinks are performing very well. There might be some commonality. Maybe he decides to do all tech stocks or all companies that have to do with like healthcare, or maybe he just wants to put the best performing stocks in the market together. And Umar is going to buy all of these. He's going to compile them together, and people will pay Umar to invest into his index fund. And you're basically getting exposure to all the companies within his index fund or his ETF. So it's a way to get exposure to a lot of different companies without having to buy directly into them. And for the most part, ETFs are slightly more stable than stocks. They're not going to go down as much, but they probably also won't go up as much. So slightly safer vehicle. Then we have bonds and we have crypto. We'll kind of leave bonds alone for this conversation, but crypto is basically, cryptocurrency. You might have heard about Bitcoin, Ethereum, Solana, XRP, all those other coins. I mean, our president has a coin now, Trump coin. And cryptocurrency can be used as an exchange of value or as a medium of exchange. So in a lot of third world countries, crypto is really big there because their currencies lose value so much. So rather than holding their money in their currency that is losing value, they put their money in crypto, so at least it'll hold value. So crypto can be used to make purchases. I mean, it's not a universal thing yet, but it's definitely a widely spread thing. So those are the things
Do
you
you
can
ever
invest
feel
in.
do you ever feel like it's going to be a universal currency?
I don't think it'll ever be like really universal, but as far as like used everywhere, yeah, for sure. I think we'll
I
get to
mean,
that point where it's accepted dang near everywhere.
that's the speculation. That's honestly that's why Bitcoin increases in value over time. So if you're someone that believes in it, we've said that we are believers that it does have value, and so that's why we're invested in crypto as well. But like
Mhm.
Dami said, for this episode, we're going to focus mainly on ETFs and stocks because mainly those are a lot safer, and then they're also the financial vehicles that we feel like can help people get to um that long-term wealth that people desire.
Definitely, like you said, they'll help you get there. And it's a better path in our opinion. So
Yep.
Let's get into like the market sector. Since we've talked about things you can invest in, let's talk about the different market sectors that exist.
All right, for sure, for sure. I feel like this is a good one to highlight because a lot of people don't know that there are multiple sectors within the financial market. They might just think of like stocks and but not know that they're in their different sectors. So pretty much what a sector is that is a group of companies within the same industry. So think of like your banks, that's in the financial sector. Think about your technology companies, those are in the tech sector. The reason why it's important to highlight this is because each of these sectors have different rate of returns from investing in it. Like one to point out is that tech sector is known to have a higher rate of return, but it's also known to be more volatile. So if you're okay with investing in volatile companies, you can look into tech companies. But if you're looking for a more safe investment, then you can start looking. Okay, maybe financials are a better investment for me. Maybe utilities are a better investment for me. So these are the things that people need to be aware of when it comes to investing, when it comes to different sectors in the market, because each sector is built different. Then also, whenever there's also a point in time where there's a dominating sector within the financial market. So for a long time, the dominating sector has been um, tech companies. But now, especially during this like Iran war that's going on, we've seen that energy has been a dominating sector. So it's important
Mhm.
to know what's going on at this point in time and highlighting the sector that's dominating in the market. All right, we're going to list out some of the sectors that we do have and then some stocks and ETFs that people can invest in if you're interested in this sector. So one, like I've said earlier, is the tech sector. Within this, you have your Nvidia, you have your Microsoft. These are all tech companies that people can invest in. They're also known as the market leaders within this sector. So if you're looking for something within this tech sector, this is definitely one you should be interested in investing in. But if you're looking for ETFs in this sector, you have the QQQ, you have your VST, and you have your XLK. These are all good ETFs to invest in as well. The next one is healthcare. Now, this is when we're talking about our Eli Lilly, Johnson Johnson, Pfizer. These are all pharmaceutical companies. And then ETFs that you can invest in here are the VHT, which is the Vanguard ETF. For financials, as I've mentioned, we have JP Morgan, Capital One, Berkshire Hathaway. These are all good financial companies you can invest in. I I like investing in financials because obviously the financial institutions hold the money for the economy.
Money makes the world go around.
Pretty much, exactly. And a good ETF in this sector will be your XLF. What other sectors do we have, Damian? Some of the stocks that you can mention for us.
So, going back to what you were talking about, like energy, we have the energy sector, which is you'll see like your oil and gas companies, which are your Exxon, your Chevron, GEV, and an ETF you'll see there is XLE. Then you have communication, where you'll see your companies like your Meta, your Google, with XLC as the ETF, and then consumer discretionary, where you'll find like your Amazon and your Tesla, basically selling stuff to people. So those are a few of the sectors that we have. One thing to note about different companies within different sectors is uh, there's a lot of different companies in each sector. So when you're doing research and you're looking them up, you want to pay attention to the market cap so you can know who like the big dogs are. The market cap is basically the value of the company as a whole. So going back to like your points on the financials, you have companies like JP Morgan, Goldman Sachs, and SoFi, which is within the financial sector, but they all have different market caps. JP Morgan's market cap is 803 billion. Um, Goldman Sachs has a market cap of 268, and then SoFi has a market cap of 21 billion. So those are all different companies. So the first two, JP Morgan and Goldman Sachs, would be considered mega cap companies because they're over 200 billion. And then SoFi is considered a large cap company because it's between 10 billion and 200 billion. Then we have mid cap companies from 2 billion to 10 billion. And then we have small cap companies that are under 2 billion. So from 300 million to 2 billion, but basically anything under 2 billion. It's crazy to say a small cap company is $2 billion.
2 billion. Like that number doesn't even sound real.
And then we haven't even talked about
The
the
trillion.
Nvidias, exactly. The
Yeah.
Nvidias,
trillions.
the Microsoft, the Metas that are worth 2, 3, 4 trillion.
Yeah. No, it just shows that like you said, in each sector there are different levels to it. And that's one thing that investors should pay attention to. Like, are you investing in a mega cap within this sector? Are you investing in a small cap within this sector? Because that also helps you know, okay, are you going to be able to make money from this company? Is it an up and coming company? Is it a market leader? Is it established? All of these things are important to know when you're looking to invest in a company.
Sooner or later, they're gonna create a new cap called like a super cap or something for those
Super
top
for the trillion, yeah. I mean,
Yeah,
yeah, I think something for like the $1 trillion club, they need something for sure.
for sure, for sure.
All right, now we want to deep dive into how we know what the companies within these sectors, how we know if they're good investments. And so there are two main ways that you can go about doing this. One is by looking at the fundamentals of the company, and then two is using the technicals of the company. I'll focus on the fundamentals, and I think Dami would touch on the technicals for us. But pretty much what the fundamentals are for a company is that it lets you know like the what and why of what's going on with the business itself. It lets you know, okay, what is the function of the business? How much money are they making? What is the growth over time? And then why you should invest in this company. Those are the things that a fundamental metrics helps you understand when it comes to these companies. So one of these metrics that I would like to point out would be the earnings per share. That's the EPS. You might have seen this if you're looking at a financial sheet or you're looking at a stock, trying to find out more financial details on it. But pretty much what it is, it indicates how much money a company makes from each of this share. So the higher the EPS, the more profitable that company is considered to be because it means that you can make more money if you're invested in that company. And so it's calculated by dividing the net income of the company, so how much that they're making, maybe over every year or every quarter, by the number of outstanding shares. So the number of shares that people own of this company. So if a company has a high EPS, it means that okay, for everyone that's invested in this company, they're going to make this amount from they're going to make this amount of in dollars by investing in this company. So you're looking for companies that have high EPS because you know that you get a higher return, which are a higher bang for your buck by investing in that company. Another metric to highlight will be the PE ratio. So that's pretty much the price to earning ratio. What this does, it helps you assess the relative value of the company's stock. So it measures the company's share price relative to its earning per share, which we just discussed. So you do this by dividing the stock price by the by the EPS. With the price earning ratio, it's not the way you use it is that you use it to compare companies in the same sector as we've talked about earlier. Because if you're looking at a particular sector, you want to know which company should I invest in, and you're going to compare companies to companies. So let's say I'm looking at financials. I want to know if I should invest in JP Morgan or I should invest in Capital One. I'm going to look at the PE ratio to see which has a better PE ratio. If a company has a high PE ratio, that means it has a higher growth expectations from investors, but it can also mean that it's overvalued. So it's a fine line between there's still room to grow for this company or it's currently at that overvalued price and investor might be pulling back. If it has a low PE ratio, it means that it's either struggling in this sector or it's at a discount. And so this might be the time to buy it. The way to decide is looking at the average PE ratio for companies in this sector. So you want to find something that's closer to that medium, that average PE ratio, because that means, okay, this is right around industry average. And if it has other good financials, most likely is going to grow over time. So that's really one of the ways that you can decide between multiple companies in the same sector. That's one of the ones that I like looking at for companies as well. Another one that I wanted to highlight is the revenue growth. And this is pretty simple. Like, how is this company growing over time? So you can easily find this on the financial, on the balance sheet of a company. Is it making profit year to year? Is it losing money? Obviously, if a company is losing, if a company is losing money, you might not want to invest in that. And if they don't have good reason as to why they're losing it, you don't want to invest in that. So making sure that you know what the revenue looks like, and then market position. Like I said, you want to invest in the top dog, as Dami said. You want to invest in the market leader
Big
of a
dogs
sector.
only.
The reason why is because these companies are already established. They have good P ratios. They have high EPS. Their revenue is growing year to year. These are the companies that make up the U.S. economy, and so why not invest in those? Yeah, yeah, it's cool to find companies that are not necessarily on everyone's radar. But if you're looking to just get started in investing, those companies that have been known to make people money, like your Nvidia, your Microsoft, those are your safe bets starting off. And then from there, now you can start doing your research into finding other opportunities to make money in the market. But leaning definitely leaning more to market leaders when you start investing is the way to go.
For
But I
sure,
mean,
for
so yeah,
sure.
those are the main fundamentals that I feel like people need to pay attention to when it comes to deciding what to invest in.
Yeah, some good context you put there too was when you were talking about PE ratio, is how you mentioned that you want to compare PE within a sector. So
Hmm.
um, by knowing what the PE ratio of the sector is on average, you can then compare where your company that you're looking at stands. Because like you said, it's kind of, it's not an objective number. It's kind of subjective. It could be overvalued depending on what the company is, or it could be that the company is projected to make a lot of growth. So context really matters for PE ratio.
Yeah, and then another thing to point out is that the PE ratio is different for each sector. Like,
Hmm.
um, technology sector might have a higher PE ratio than your pharmaceuticals, so you shouldn't be comparing the PE ratios of companies in different sectors to each other.
No, no, cool. Thanks for giving us that. So I'll take this another step further. You talked about how you identify what to buy. We're gonna get into the technicals and try to identify when to buy, because every price is not a good price to buy.
Uh-huh.
So starting off that statement, you never want to buy a stock at its 52-week high, or really at its all-time high. So what is that? 52-week high is the highest price a stock has been in the past 52 weeks, or all-time high is the highest price a stock has ever been. You don't want to buy a stock, or you don't want to buy any shares of a company at its 52-week high or its all-time high, because the risk to reward is now not in your favor. Could it possibly continue going up? It could, but
Yeah.
it's more likely that it's going to go down before it comes up. So you want to avoid buying at those prices, and the same thing vice versa. You don't want to sell when a company hits its all-time low or its 52-week low. If a company is dropping, all companies drop. But don't wait until it gets to its lowest price has ever been to decide, okay, I'm going to take the L
So yeah.
and sell now. Or don't wait till it gets to its 52-week low to decide if you're going to sell, because now you're taking a really bad loss. It's been dropping. It dropped 20%. You could have just sold then. You could have just sold at 30%, but you waited until it got to its 52-week low. Now it's down 75% and you want to sell. It's not a great idea. So that's one thing. Secondly, understanding trend direction. So trend direction, basically with looking, when you're looking at companies, there's two major trends: uptrends and downtrends. And we have sideways, choppy trends, consolidation, whatever you might call it, depending on what it's looking like. But those are not really a direction. It's kind of moving horizontal. But as far as like actual movement, stocks move in uptrends and they move in downtrends. And one thing to note is that they don't move in straight lines. So there's going to be a impulsive move, as they call it. So you'll have a big move to the upside, and then there'll be a corrective move. So big move to the upside, then there's going to be a small pullback. Then it's going to move big to the upside again and a small pullback. It's just how it works. Same thing with the downside. There's going to be a big impulsive move to the downside. Then it's going to come back up a little bit, and it's going to go down some more because everyone's selling it, and it's going to come back up some more. Stocks do not move in straight lines. Don't be deceived to think something's going to go up or down forever. One thing they say about the stock market is that it goes up like stairs, but it comes down like an elevator. So definitely keep that in mind. When people sell, panic selling is a real thing. And it's not fun being caught up in those cycles.
You don't want to be on that losing end for sure.
No, it's not. It's not. It's not fun at all. Cool. Let's talk about volume. So volume is really good because volume adds some color or context when you are looking in position. So volume basically is the number of market participants at any point in time. So what do I mean by that? If you're looking at a chart and it's a daily chart, right? Every little tick you'll see a bar under it. It's going to be either red or it's going to be green. And if it's red, that means there was more sellers that day. If it's green, that means there was more buyers that day. And that vertical bar represents the number of market participants that were present that day. So it doesn't necessarily mean they were all buyers or they were all sellers. It just means that there was more buyers than sellers during that period. And this can be on the daily chart. This can be on an hourly chart. This can be on a 1 minute chart. It represents the same thing. So volume gives you a lot of context because you'll see that certain prices people buy a lot more, or certain prices people sell a lot more. And just adding that additional context can help with knowing when you want to buy, when you want to sell. For example, if you see that the stock is moving down and the volume is really high, maybe you might want to chill for a second because there's a lot of people selling. Or if you see the stock is moving up and the volume is really low, maybe you want to wait because you don't think it's going to be a strong move because it's not being pushed by a lot of volume. The last one I'm going to get into here is support and resistance. So support and resistance can also be called price floors and price fillings. And because this is episode 10, we're going to do something different. I'm going to share my screen and kind of give you a visual representation of what I'm trying to say here. So bear with me. This is first time doing this.
The first ever on Common Sense of sharing our analysis.
Facts. Perfect. So this is up now. So on my screen, this is example of what a stock chart, how it moves. Sometimes it moves sideways, moves up and down. But support and resistance, as I mentioned, can be also called price ceilings and price floors. So support is a particular level in which price hits and it's being supported, it's being held up. So when price hits support, a lot of the times people will buy it back up and it will go up. It doesn't always have to go back up to resistance, as you can see here, but a lot of times it will. And resistance is the exact opposite. It's the price ceiling. That's kind of how stocks move until volume pushes it one way or another, which is why volume is important. So as you can see here, now we broke through this resistance above. And the thing about support and resistance is that when you break through that, now whatever it is, whether it be resistance or support, flips to the other thing. So this was previously resistance, but as we broke through, it now becomes support and we have a new resistance, and vice versa. If we have broke through this floor right here and went down, then this floor would now be a ceiling and we'd have a new floor below us. So support and resistance also provides good context for when you should buy. For example, like if you know a chart is moving through support and resistance, like right here, um, you might decide that next time it comes back down, I'm going to buy it with the anticipation of it going back up. Or if you see that it's been tapping on this up here a few times and you see volume, the next time it taps, you might decide I'm going to buy it here because I see the volume and I think it's going to break through it. So this is just context. It's not investment advice. Do your own research and put together your own ideas and formulations based on how you would like to invest. But I just wanted to provide some visual context for that one because it might have been confusing to explain if I didn't put a picture up there.
No, that was good insight for sure. I mean, if I was someone that had no idea what support and resistance, that visual definitely helped. Like you said, the support is basically the floor price, and then the resistance is the floor ceiling. So you're basically trying to see if the price it goes can break either of those, and then when it does, that that resistance or support that it broke, it becomes
Mhm.
a new it becomes the opposite thing.
Yep.
So that was
Yep.
good insight for sure. And like
Yep.
you can see, I mean, not all charts don't always follow that, but like your typical like chart movement, that's what investors are looking for as they would say, like they're looking for the right time to buy. Like Dami was pointing out, if you see that a stock is hitting its the resistance multiple time, and then at this next time it has the good amount of volume to break that resistance, that might be the time to buy. And so those are some of the things that investors are looking for to decide whether they want to buy a stock at that point in time or not.
For sure. For sure. One thing I didn't mention there was volatility, and volatility is just how much
Mm.
price moves. You mentioned it earlier, but I figured I'd wait until I started talking to talk about it. But volatility is how much a price moves. So, for example, a stock in which that's not volatile, like the ETFs we're talking about, they might move up 50 cents a day, either up or down. Whereas you have some companies that are super volatile, they might move up $10 or they can move down
$20.
$10. Yeah, yeah. So volatility is something you should be aware of because things happen very quickly for companies that are volatile.
Yeah. Yep. Yep. All right, thank you for that. Thank you. That was good technicals. I think that if anyone that doesn't know anything about technicals, after listening to that, you definitely picked up one thing or the other from that you can use when you start looking at charts for sure.
Hmm.
All right, moving on. So now we've talked about how to identify what companies you should buy, why you should buy those companies, and also when you should buy those
When?
companies. Yep.
Hmm.
So now we want to talk about some of the key financial principles that once you know all of this, you start putting that together. The first one that I did want to mention was dollar cost averaging. So this is a common financial that people use. Pretty much what that means is that you're continuously buying a stock regardless of the price of the asset. Meaning that if you have an entry point at, let's say, $15, you're consistently buying that stock either weekly, monthly, just trying to add more positions to that. And then you're adding and you're buying it at that new price at whenever you're buying that new stock. So let's say on day one, you buy that for $15. The next time you're buying the stock, it was at $20. Basically, now that you've bought that stock at $20, the average would be around $17. So that's pretty much dollar cost averaging. Though you didn't buy it at the original 15 price, but you're averaging your position within the stock. The reason why people do this is that it removes emotion when it comes to investing. Like, you're not always looking at, okay, is this always the right time to buy? Because like Dami has shown, this can get overwhelming for a lot of people. Some people don't really know how to use that technical. So if you want to remove that emotion, you want to remove the technicality that comes with that, you can just dollar cost average into a good asset. And that leads to my next point. Most people usually dollar cost average into ETFs and index funds because that's a safer bet, meaning that you're not always going to be buying because the volatility is not as high as individual stocks. The dollar cost averaging is not as drastic as it would be with let's say like a more volatile. So with a more volatile stock, you could buy all-time highs, and that might not be the best time to buy. So you want to make sure that you're doing this at the right time, and that's another thing as well. So that's why I encourage people to do this mainly with ETS, because you obviously want to increase your position in that, but you also don't want to buy when things are at their all-time high. So if you're doing this for index funds, you're able to put money in it over a long period of time, and then your position continues to grow while dollar cost averaging at the same time.
Yep, that's really good.
All right. So another financial principle that can help people is diversification. And this goes back to pointing out that the different sectors within the financial market. One, you don't want all of your money in one asset, and don't want it in one sector. The reason being is that anything can happen where the stock can plummet and all your investment goes to zero, or the industry or the sector that you're investing in might not be the hottest industry anymore, and now all your investments are going down. When that happens, that drastically affects your portfolio. And so to prevent that, to be more risk averse when it comes to that, that's where diversification comes in. So, and that's another reason why ETFs are a really good vehicle for people to invest in, because this automatically diversifies your investment for you. It invests in different companies within the sector, or like Dami said, if you're investing in a fund, it accumulates multiple stocks within this fund. And so that's one of the ways that you can diversify. But if you're investing in individual stocks, make sure that you don't have all of your money in one stock, and you don't have it all in one sector. Like I mentioned earlier, we've known that tech is one of the hottest industries, but over the past couple months, we've seen that tech has not been performing as good as other sectors like financials, or even
Volatility.
exactly, or even energy these past couple of weeks. And so if you had all of your investments in the tech sector, that you might not see the rate of return that other people are seeing in different sectors. So making sure you're invested in some of the different sectors is a good way to diversify your portfolio.
Yeah. There's also such a thing as over-diversification, so don't so try to stick to a few great companies.
Hmm. Like we said, market leaders. Focus on the
Market
market leaders first, and then you can play around with your money if you want to.
big dogs only, like you said, big dogs only. Cool. So now I'm going to talk a little bit about compounding. So we talk about compounding a lot in our episodes because it is the eighth wonder of the world, as they say. So compounding will take you far in the stock market as long as you continuously buy and invest. What do we mean by that? For example, let's think of a company like Meta, or actually, I'm going to say a company like Costco because I want to go somewhere with this. Costco is a company that does dividends. So if you're buying into Costco, Costco is growing over the years. You're putting money into it. Your money is making money. The company is growing. The share price is increasing. So not only is your investment growing, but you're also increasing the amount of money you put into it. Now, and then on top of that, you're being given a dividend every 3 months. So they're paying you to own the stock. So, like I said, your money is growing because the stock is increasing. Your equity is increasing because you're putting money into it continuously every month, and you're getting a dividend. So that's three different ways in which your money is growing. It's being compounded. So compounding is a superpower when you're investing.
Yeah.
But the thing to note is that compounding has the biggest impact when you're consistent and when you allow it to take place over time. You can't expect to see major compounding results after a year of investing. But after 3 years, after 5 years, you'll really start to see it. After 10 years, that's when you start to really understand the power of compounding, where your investment has grown 500, 600, 700% from what you initially invested into it. So
Hmm.
compounding is definitely one of those things you have to let play out in your investing journey. Don't rush it. Then I'm going to talk a little bit about risk versus reward. So in everything in investing, you have to understand what your risk versus your reward is. Uh, Going back to Umar's thing about volatility, some assets are a lot more volatile. So the risk versus reward might be a lot higher in the sense that, like, yes, you could make, I don't know, you could make $1,000 on this, but you could potentially lose 500 on it. Whereas a less volatile asset might only give you $10, but at the same time, you could only lose $1 on it. So understanding what your risk versus your reward is when you're investing is crucial, and make sure that the risk to reward matches your personality or your risk tolerance. Some people um, don't want to lose a lot of money, and they're okay with making a little bit of money as long as they're not losing a lot of money. Whereas some people they risk it for the biscuit, and if they lose money, it's
They
fine.
live life on the edge.
They live life on the edge. So yeah, we mentioned it in one of our early episodes. I believe it was investing for beginners part one. Is like you have to know yourself and know what risk you're willing to tolerate in your investment.
Yeah.
So I would say really you should find out that number. Like, for example, for me, my absolute number I never want to lose more than is 30%. After 30%, it hurts me. It hurts me. Like, I really try to stay under 20, but 30 is like, no, I don't want to lose anything more than 30%. Cause how I think about it is like, once I lose 30%, I've lost almost half of my money. I don't want to ever lose almost half of my money. So
Mm.
that's just how I think about it.
No, that's good. That's good. I mean, yeah, I think like we've mentioned earlier, like there are different kinds of investors. And so knowing who you are is very important because that lets you know how risk tolerant you are. So if you're someone that, and that's why we haven't even talked about going to crypto because that's a different kind of risk that you have to
Mhm.
be able to withstand. But if you're someone that, okay, you just started investing, you don't have a lot of money to lose, obviously your risk tolerance is lower. You're
Mhm.
not going to look for that volatile stock to invest in. Invest in something that's more safer, and then so you can build a good base. And then from there, now you can start looking at the stocks that are going to give you 1,000% return from investing in it and stuff like that.
Yeah.
But nah, that's good. That's good. I mean, those are good financial principles. So dollar cost averaging, diversification, compounding, and risk and reward. These are all things that you need to pay attention to when it comes to finding a good investment. All right. So I have a question for you, Dami. So now that we've talked about all of these principles, what would you say is like a simple beginner strategy for people to use when they just start their investing journey?
So I'm gonna give you first of all, when I'm going through this, let me know what you think.
Cool.
But what made me smile about this, I'm gonna give you a strategy that I did not use because I was not a good beginner
Because we
investor.
didn't know. Exactly, exactly. These are
Yeah.
things that I mean, and that's the whole point that these are some of the things that we wish we knew when we started off, but
Mm,
now we know just from experience and
yeah.
taking some L's, you know?
Yeah. So if I was starting as a beginner right now, the best thing you can do, buy ETFs. Just buy the ETF. Don't
Mhm.
worry about individual companies. You're getting exposure through buying the ETF. Because the thing about it is like when you're a beginning investor, you don't need to be looking for 50% returns. You don't need to be looking for 100% returns. What you need to be looking for is consistent growth. What you need to be looking for is how you can build capital without risking a lot of it. Granted, a lot of those stocks that people want to buy in the beginning, they do have great returns. They do move well. But when you're beginning, you don't have enough capital to be risking it. Your biggest thing should be capital preservation. You want to make sure you hold on to as much money as possible. So
Yeah.
you want to invest in ETFs. That's the best thing you can do. Once you buy a few ETFs, maybe you can get a really strong company, one industry leader, one sector leader here, one sector leader there. But you really want to build your base with ETFs because you know that even when things get bad, the drawdown will be minimal. So start with ETFs, then I'd say then you could add like uh maybe a few companies, maybe no more than two or three to be honest. But definitely build your base with the ETFs, add the companies. Then you want to make sure you're doing it consistently. You want to consistently add to it. 'Cause it goes back to our compounding conversation. Your money is not going to grow if you don't consistently keep adding to it. So if you're investing into the ETF, I don't know, let's say the ETF is called ABC and it's at 500 today and you put money into it and you don't add any more to it. Like, yes, your money is going to be increasing because the company is growing over time, but you're not adding more money for your money to increase as the value
You're
increases.
not increasing your position in it. Yeah.
Exactly. You're not increasing the amount of equity you have. So you bought one share, but you need to own two shares and then you need to own three shares and you need to make it to 10 shares and 100 shares eventually so that you can really feel the impact of the growth. So you got to invest consistently. And then once you get through those first few stages of building that base and consistently investing, then you can start to diversify a little bit more. Like I mentioned, you can get like a company here or there. You can even get some crypto if you really want to. You can open your exposure up to crypto a little bit because
Mhm.
crypto has good returns. Even though crypto is very volatile, crypto has really good returns if you buy it at good prices. You want to allocate a smaller amount of money to that because ideally, for the way this portfolio is being built, you don't want it to be impacted by the major drawdowns of crypto. It's a small account and you're a beginner. So, like I said, you want to minimize your drawdown. So, you can diversify at that point. And then lastly, keep it simple. Keeping it simple in the sense that you could set it up that every month you're depositing, I don't 250 or 1,000, whatever you're depositing. Every month you're
Yeah.
depositing $250 and you set an automatic purchase of $50 in ETF A, $50 in ETF B, $50 in ETF C, $50 in company A, $50 in company B. No thought. It's just automatic.
It's
You're not having
automatic, you know?
you're not having to put any thought into it. It's not confusing. It's very simple. It's straight to the point and it's consistent. So what do you think about that?
No, I agree with that. I agree with that. I think what I would say, like in the beginning stage, probably like you said, buy the ETFs. I think it would be find two, three sectors that you want to invest in, like that you
Mhm,
feel confident investing in. So it could be it could be the tech sector, it could be financials, and it could be pharmaceuticals.
mhm.
Like find those three, and then within that three, then you can start like you can pick the ETFs that you want to buy. Like Dami said, start with ETFs. I like how you said that, like, that gives you the good base that you need starting off. Like, you don't need that 50% return right away. Like, find like the ETFs that are going to give you 5, 10% consistently year over year. And then once you have that, now you can start diversifying into looking for, okay, what are the market leaders? What are the market leader stocks that are going. And then and another reason why I like starting with ETFs is that with the different sectors, that you know what sector is performing the best. And if you see what's performing the best, all right, now maybe it's time to invest in those companies that are performing the best within that sector. So that's really the playbook. Like Dami said, I didn't start like that either. I
Mhm.
didn't start ETFs. Like we started with individual stocks, but these are things that we wish we knew starting off, that we see that could have been a lot more helpful.
Yeah.
And but yeah, and then do it consistently, dollar cost average, let compounding work. Those are all the key principles that we pointed out, and keep it simple. No need to buy 10, 15 companies when you're just starting off. That's a lot to manage. You're not going to manage it properly. You're going to be distracted. You're not going to see where the real returns are happening. So just keep it simple. I would say that's like the best strategy starting off.
Facts. No, that the finding the sector is a really good point because, like you said, it can direct you later on for choosing a stock because you already know what sectors are leading the stock market. So
Performing, yeah.
that's a really
Yeah.
good point there. That's a really good point there. So, um, that's valid. Let's kind of move on to the next part of this discussion. Let's talk about some common mistakes that we both exhibited because we just went over our simple
We just
strategy.
talked about, I mean, yeah.
Yeah. So let's talk about some things. I mean, that's the realness you get with common sense. For the most part, every episode we tell you about some of our mess ups, some of our mistakes, and how we would go about them now that we have the knowledge to do better.
All right. So I just mentioned obviously that I was buying individual stocks rather than ETFs. So I'll say that's one mistake that I wish I knew better at that point in time. Another thing is just buying a lot of stocks. Like I remember when I first started, it was like, okay, like, all right, I like Nike. Let me buy Nike. I like Apple. Let me buy Apple. I like
Yeah.
Microsoft. I like let me buy all these stocks that I like. But like just looking back at it is that if I had focused on one individual company and then was just putting money into that consistently, because all these companies all did not grow at the same rate. Like some had better returns than the other. And so
Mhm.
if I was just investing in that company that had the better return and putting a lot more capital into that, I was building my equity, I was building up my position in this company, I would had better returns rather than just diversifying into a lot of these stocks without knowing exactly what I'm investing in. So I would say over diversifying was one of the mistakes I definitely made starting off.
Mhm. Mhm. You want to go like back and forth here?
Yeah, you go.
All right, cool. I say about a mistake I made commonly, and this one hurts, is not knowing when to let go of a bad investment.
Nah, facts,
That
facts.
one hurt. So there's definitely a lot of companies where you'll be like, you'll be like, man, it's coming back. And it goes back to our point earlier about selling at a 52-week low. It's something I've done
Mhm.
before. Like you hold it, you're like, it's gonna come back, it's dropping, you're like, it's gonna come back. And then one day you see 52-week low. Now you start thinking about it different. Now you're like, oh my gosh, like
Why do I still have this kind of,
why do I
yeah.
still have this? And then it's like, it's disgusting to you. You just want to get rid of it. And you should have got rid of it a lot earlier. And that's
Mhm.
going back to my point earlier. That's how been able to discover that 30% number for me. Cause, it wasn't 30 before. At one point it was like way higher. At one point there was no limit. And at one point I was
It was like
like,
100%,
yeah. And then I was like,
98%.
99, exactly. And then at one point I was like, okay, I can do 45, 50. And I realized 45, 50 is cutting into my capital. So that's
Yeah.
why like 30% is the number I try to abide. Don't get me wrong. I still take losses more than 30% sometimes, but for the most part, I avoid it as best as possible.
Nah, facts. That's a good one. I mean, we've all had those stocks where you're like, I like this company, like I'm gonna keep this stock,
Mhm.
but then we see it keeps going down, it's not recovering. Like we've had those for sure. All
Yeah.
right, okay. Another one I'll say is not buying at the discounted opportunity. Like when people
Mhm.
say buy the dip, like that's so real. That was something that I was not a believer in at first, because okay, if something is going down, like you're scared that it's going to keep going down. So it's like you're not going to want to put your money in there. But obviously, if something is going down, it's bound to recover, and you want to be on that train that's on the recovery train, where now like, okay, so now it has the volume that it needs to go back up, it's going to get to those all-time highs, and you want to be on that train that's getting there. So that was one thing that starting off, I was not, I was not implementing into my strategy. I would just buy, like I'll buy at the high price. Like that was something I remember doing. I'm like, and then I'll be surprised when it pulls back. So
Mhm.
that was something that I remember vividly, that okay, like now that I know this, I'm never doing this again. So when people say
Yeah.
like, oh, the market is red, they're scared to buy, like I'm excited because now I'm like, okay, I can go shopping, I can find like stocks that I've always wanted to buy. I can see if it's at my price target. And now I got in a good price. Now let me just see where it's going to take me in the next 2-3 months. What is it going to look like? Because obviously it's not going to be down forever. And that's
Mhm.
where, like, I guess the technicals comes into play also, because if you see that it's approaching that it's approaching that support level, it seems like it's okay. It didn't break the support. Now it's about to rebound. Okay, that's perfect time to buy. Let's see what's going to happen. But
Mhm.
that was one for sure, buying the dip.
Let me add one thing there. You said it's bound to recover. Good assets are bound
Good
to recover
asset. Okay, good assets for sure, for sure.
because some of them. I mean, we've been there. There's
That's
definitely been
true. That's
some
true.
that you
That's
buy
true.
and you like it's gonna recover. And next thing you know, the stock is less than $1. Have you ever had a stock that's less than $1?
Oh no, yeah, I've had those. I've had
Nah, it's
those.
crazy.
No, there was one time I was just like I was like I needed to cleanse just like rubbish stocks that were in my portfolio. I was like,
Nah,
what is this still doing in here? So like those are the ones that you just like have to get rid
yeah,
of. Like
get rid of, take the
You
L,
took
and
the
never
L, get
again.
rid of it. Hmm.
Yeah, facts. That's why sometimes when I have conversations with people where they mention certain stocks, I'm not talking to you. I'm not talking to you. If I'm talking to you, you talking to me about GameStop, AMC. There's nothing to talk about.
Yeah,
There's nothing to talk about.
you're riding the wave. That's what it is. Like,
Yeah, yeah. You're not buying good companies. Cool. So my next point kind of trails to what you were just saying. And I had something else I wanted to share that I was keeping for like the end when we talk about like when we do our economic events thing, but it kind of correlates to this. So I'll share it now. Um cool. So it's episode 10. You know, we're doing things bigger and better. We're trying to add more value to our podcast. So I went and did a little bit of research for the people out here. So one of the mistakes I made early on was trying to time the market. Trying to time the market is setting yourself up for failure. You can't time it. You're not a fortune teller. You cannot predict the market. And what I have on the screen right now is basically showing the 10 best weeks in S&P history by point change, the 10 best and the 10 worst. And the reason why I have this on the screen right now is because I'm trying to show how if you try to time the market, or if you stay away from the market when it's red, you'll miss some of the best buying opportunities that ever present themselves. So
mm,
I use colors to coordinate them by dates. And basically, if you see two colors that are the same, they're within 1 month of each other. So up top right here, we have 4/9/2021, 2020. The S&P gained 301 points during that week. But 2 weeks prior, it had lost 406 points. So if you decided that you didn't want to invest during this drawdown right here, if you didn't take advantage of this buying opportunity, 2 weeks later, the stock was already rebounding and you missed the opportunity. So that's one right there. Or the one that's probably most relatable is last year during the
last year
Trump
April.
last year,
Yeah,
April, the market was bloody. I mean, we all kind of remember that. And if you look right here, 4/4/2025, this is actually the worst week in stock market history as far as like point change, not percentage, but point change. Last April, we had the worst week of all time. The S&P dropped 500 points in 1 week. 4/4. The following week, we have the second best week in S&P history as according to points. The stock market went up 289 points. Then another 2 weeks later, it went up 249 points. So within the month of April, we recovered all of this. This whole drop right here, we recovered it in that same month. So trying to time the market is not something you should be trying to do. You don't
buy
know
the
where
dip.
just buy the dip.
Buy the
Buy
dip.
the dip. You got to buy the dip. So I'm gonna leave it up while I finish out my point in case you want to take a screenshot or anything. But like, think about it like this: like, if your favorite clothes designer or if your favorite car dealer told you that, all right, we're selling Benzes and they're 20% off, you wouldn't think that, oh, I don't know, it's gonna keep going down. You would go buy it immediately. People think of the stock market when it's dropping as a bad thing. You're getting assets for discount.
Yeah,
People like, this is the time to buy it. Why would you want to buy something full price? Black Friday, we all go to the store, we all go to online to buy the things we want because they're on discount. That's how you should treat red days and drawdowns in the market. As long as you're buying good assets, you're buying them at discounts. And as you can see, according to this chart, it doesn't really take that long for these assets to recover. I mean, it just happened with this Iran thing. The market was down, I think, like 7-8%. And then yesterday, they called off a ceasefire, and you seen the market went crazy. The market went
yeah,
crazy. So you have to take advantage of opportunities that are presented. Stop trying to time the market and just buy the dip, dollar cost average, do what you need to do, but take advantage of the discount opportunities.
for sure, for sure. No, yeah, that was pretty insightful. Like that just goes back to the point that you want to buy the dip. That's pretty much what it is. Because when the market is down, that's presenting you an opportunity of stocks that you wanted to buy, but now is at a discounted price. Like Dami said, if Nike is having a sale, or I'm using that sale, like I'm getting those shoes that I want. I'm not trying to pay a full price. So the same thing with the stock market. There's no reason why you should be paying full price when, okay, the market is down now, you can buy at a discounted price. So yeah, that was good. That was good insights for sure.
Definitely, definitely. It was really eye opening to see that myself. I mean, I decided to actually go find it and look for the
Do it
numbers, and it just,
yourself. Yeah.
yeah. And like when you see it, it's like, dang, like, I mean, sometimes we live through it. It's like you'll be like, oh, I'm gonna buy a dip, I'm gonna buy a dip, and by the time you try to buy it, the dip's already done. Like
It's
it's
too
already
late.
gone. Yeah.
It's too
So you
late.
gotta buy it.
I mean, that's what happened today. Like you said, like, okay, Trump said, all right, we're not no more, we're not bombing Iran
We're not
for 2 weeks.
destroying civilization,
We're not bombing Iran for 2 weeks. Now the market is rebounding, everything's back up 5%. Like
and it was overnight, so you didn't even have the opportunity.
to get into it, yeah, get into the
Yeah,
stuff. But
yeah.
all right, that's good. That's good. I like that we share some of our L's, so hopefully people can learn from that. All right, so moving on to everyone's favorite segment, is it making sense? So this is where we bring up made up or real life scenarios, and we decide if it's making sense or not. All right, so I have one for you. Are you ready?
Let's do it.
All right, so you have this person. He's deciding between two companies to invest in. One is an established market leader. But this other one, he's seen a lot of people talk about it on social media. It has a lot of hype around it, but doesn't necessarily have good fundamentals. He decides to invest in the one that has all of the hype around it. Is that making sense?
It's not making sense because it's not a great decision. Like I mean, we've
Mhm.
been talking about this. Like, you invest in the market leader, you invest in the sector leader, you know you're investing in the best company. Whereas if you're going with hype, half the time when you invest with companies that are hyped online, somebody's taking your money. That's what's
They
really
are.
happening. Somebody's just taking your
They're
money.
trying to make they want you to get in so they can sell. That's what it
Yep.
is.
They're using you as exit liquidity. So like, do your research, find good companies, invest in them. But like, just because something is being hype online doesn't mean it's a good company. And it could be a good company. Regardless, you gotta do your research and find out for yourself.
No, yeah, for sure. I agree with that. Like, if you have an established market leader, 9 times out of 10, it's better to go with that. Especially if this hype company, you look at it, it doesn't have good fundamentals. You can't find a good time to buy from looking at the chart. Like, there's no reason why to just go with that because people are talking about it. So, yeah.
Facts, facts. All right. Now I have one for you. So we have um, a guy who's, he's trying to get into the market. He's been buying, and the market we just had a 10% pullback, but he's scared to buy it because he doesn't know where the economy is going. And all of a sudden the market recovered and he starts buying because he sees that it's green again. We're back. We're making new highs. We're at all-time highs and he's buying again. Is it making sense or not?
And I mean, we just talked about that. Like, that's not making sense, my guy. You lost the opportunity to buy when the dip happened, and now you're buying all time high. when stocks get to their all-time high, yeah, it can keep running, but then it's most time it's going to pull back because people are selling to take their
People
profits.
taking profit.
You don't want to,
Yeah.
yeah, they're taking their profit, and so you don't want to be at that point where you bought a stock at the all-time high, and now you just see it go down 5, 10% because people are taking profit. Now they just used you to make money. You want to be on the
Yep.
other end of that. So yeah, that's not making sense at all.
Facts. Fact. It goes back to our risk reward. Like when a company is at its all time high, their reward for the risk is not, it's not great. Whereas if you wait, if
Mhm.
you buy it when it's down, like yeah, it's down, but it's more likely to continue going back up at some point. So your risk reward is in
Yeah,
a lot better of a
a lot
position.
higher. Yeah.
Yeah, yeah. So you got that.
All right.
Cool,
I
cool,
think I
cool.
think that was
That was
good.
good. Let's move on to current events, economic updates, and things going on in the world right now. So, you want to start us off?
All right, yeah. Let me talk on one that I found quite interesting. So, I mean, if you know us, we talked about a lot about Tesla, Elon Musk. Did you see that
The stock that I will
SpaceX
never buy.
is you never buy Tesla?
Yeah, I mean, I say this all the
All
time.
right.
You know what's crazy is I
I'm
actually
kidding.
love to trade Tesla. I actually made money on Tesla today. I love trading Tesla, but I cannot own that stock. I just won't do it. But it's just one of those
Yeah.
things, we all have our experiences. There's one company, everybody has one company that I'm not buying this company. I
You
had a
stay
bad
away
experience.
from.
Mine
Yeah.
was Tesla. I bought it at highs. I bought it at highs. Never been the same.
But yeah, so yeah, one of Elon's company, SpaceX, is said to IPO this year, sometime mid-year, maybe July or so, June, July, I believe. So SpaceX IPO is also said to include Starlink and XAI, which are his other companies. And so this is one of the largest IPOs I think it's ever said to happen up to now. So it's about going to be about $2 trillion. Saying that out loud doesn't even make sense. $2 trillion, but I mean that I think that's kind of like groundbreaking news because obviously a lot of people have been speculating that SpaceX is really the company that is going to take off and people are really going to be invested in this. So
Mhm.
are you gonna be a believer of SpaceX when that happens? Are you gonna buy the stock or how are you feeling about that?
I'm definitely a believer of SpaceX, just not for the first 3, 4 months.
I mean, yeah, I guess rule of thumb is that you don't want to get into the stock the first 3 months because that's when the initial investors, the people that were able to
Getting these
buy the
pre-IPO.
yeah, the pre-IPO private equity, that's when they're liquidating,
Mhm.
selling their shares. But I mean, I'm excited for this though. I mean,
Yeah, yeah. I think SpaceX definitely has potential to be the most valuable stock in the stock market, in my opinion, because there's no real competition for it. And it's Elon Musk doing the thing that he really wants to do. Like
yeah,
Tesla was a good idea. Tesla is I don't want to say it's a great company, but it was a good company for the most part. But people invest in Tesla because they want to invest in Elon. Now you're actually investing in Elon's ideas. Now you're actually investing in the thing that Elon did by himself and has full control of. I think the money's gonna pour into to SpaceX. Something I even saw is that they're predicting Tesla has been dropping, and they're predicting that Tesla's gonna lose a lot of money because of this IPO. People are gonna move their money from Tesla into
from Tesla
SpaceX.
too. I mean that I can see that as well. I can see it as well.
Hmm.
But I mean, another reason why like this stands out is because like it's going to include Starlink and XAI. So for people that don't know, Starlink is pretty much like the like a wireless connection that that people can use anywhere. And so when
Mm.
you have like your own space company where you can put satellites in space, like that's you can have connection wherever you want to. Like it doesn't even matter, okay, if it has good connection in that area because you have that satellite in space where you can set up your own internet connection, you can set up your own wireless connection. There's no limit to what you can do with your own wireless company. And
Were
then
you
XAI,
exposed to? Were you exposed to Starlink in Nigeria? I seen a
I
lot of
didn't use
people have
it.
it.
Yeah, yeah, but I didn't use it when I was in Nigeria. But I
Yep.
mean, that's so like that's an example of like using it in rural areas, or I won't say rural, but using it in countries like that, that don't have easy access to internet. That goes a long way for
Mhm.
sure. And now you can put your own satellites in space whenever you want to. Oh
Yeah.
yeah,
2 trillion is crazy though. That 2 trillion evaluation IPO that's ridiculous.
nah, yeah.
Yeah, it'll definitely surpass 2 trillion very quickly, but
Eventually, yeah.
IPOing at 2 trillion is crazy. So we'll see. When it IPOs, I might trade it because I know everybody's gonna try to buy it, and it's gonna plummet. So I'm gonna trade it for sure. But once it like pulls back, I'm definitely gonna be a buyer. I'll say I'll buy that one for sure.
All right. Well, it's all speculative, so
Mhm.
we'll see what happens when it actually IPOs.
Facts, facts. Cool. So we're coming to an end. I talk about this on every episode at this point. Jerome Powell, his last FOMC meeting will be at the end of this month, and then after that, we'll get a new Fed chair. Um, we'll see how it goes. There's like a 90 something percent chance of them not cutting rates. Doesn't look like they're going to cut rates. But I don't know. The
Right.
market just bounced back this week. If it stays up high, they may consider cutting rates again. But when everything was down in the gutter, they definitely weren't about to cut rates.
That'll be interesting to see. Like, I guess
Yeah.
what his last meeting would look like, or
Mm,
last instruction, or
yeah.
will be.
Definitely, definitely. I like to tap in when he speaks, but I'll definitely pay attention to this one because I want to see if he's going to leave some instructions or some notes for the people in his last FOMC meeting. So I think the date is like April 28th or April 30th. I don't know. It's the last week of April for sure.
April, yeah.
Yeah.
Okay. Cool, cool, cool. All right.
All
If
right.
you're listening, we're recording this episode April 8th. Yesterday, Tuesday, Trump has said that he was going to bomb a whole civilization in Iran. Come to find out, he agreed a ceasefire. Said he's pushing this whole issue by 2 weeks, and so now it's no longer happening. I want to know like your opinion of like leading up to Tuesday. What did you think was going to happen, and then after seeing that news, like what do you think?
So the whole time, um, I was hoping that the US would not go and bomb that place because I think it leave a bad taste in a lot of other countries and how they see us. And two, I know, and it hasn't reached that point, but I knew and I know that we're going to get to a point where we're going to make a deal and we're going to have to give something up, which it doesn't make sense. One thing Trump does a lot is he makes problems and he comes up with solutions for the problems that he solves. But in this case, the Strait of Hormuz was already open. So it's like we're paying twice for it. Like, imagine paying twice for something
Well,
you already had. It
there was
doesn't
no
make no
issue.
sense.
Yeah.
There was no problem, but you made these people go close this thing, and now you got to pay them or you got to make a deal for them to open it. It doesn't really make any sense. So, did I think they were going to let hell rain down in his words, not mine? No. I thought there was a possibility, but I was really hoping that that would not happen because it doesn't make sense. Like, and it's like they, you can do all of that, and they can decide we're still not going to open it. So now, what are you going to do? So I'm happy that
Yeah.
that didn't happen. What about you?
I mean, and then it also would have led to like an actual like full out war. Let's
For
say like,
sure. For
okay,
sure.
if you're bombing, now you have to send in like ground troops to to see what's happening on the ground,
Yep.
to finish up the mission or whatever.
Yep.
And now obviously Iran is going to strike back. So it really would have led to all out war. I mean, even when he said this, like I remember you telling me like we thought it was a joke. Like when we
It
saw
looked
the
like a
tweet,
joke.
it looked like
Facts.
a joke. Like there's no way the president really like put this
Mm,
out there. So just him putting it out there at first, it was not taken seriously until it was even confirmed. And then now that okay, we've seen that he made some type of agreement, Pakistan being the mediator to have a ceasefire with Iran. It's now like, how can we even take you seriously if you put any other information out there? Like
Yep.
now we can't really believe what you're saying. And this just goes back to also like the market manipulation part of it, where okay, now because he said there was a ceasefire, now we see that the markets are up drastically. And this is one thing that people have been accusing him of being a market manipulator, just trying to like make more money for the people that are aware of these situations that are going on. Like, I
No,
don't
there's
know.
definitely there's definitely some market manipulation going on for
Mhm.
sure, for sure. At this point, it seems like he's more concerned with the stock market and making money than actually running this country to a
Them
profit.
running the country. That's really what it
For
is.
sure,
That's really
for
what it
sure.
is.
Yeah.
But I mean, let's see what these 2 weeks have in store for us.
If we're
Who
going
knows?
off of history, we know that he's best in pushing things back.
No,
That's
I actually saw a video where like his best way to push back is 2 weeks. That's
yeah,
literally what he says.
that's what he did last year with the tariffs. It was every time it was just 2 weeks,
2 weeks,
one
two
one
weeks,
month,
two
90
weeks.
days. That's what he kept doing. So we'll see how it goes. We're not in the clear yet. We're not in the clear yet, but we'll see how it goes.
Nah,
In other Trump news, I saw something that he's allegedly trying to put his signature on the
on the
dollar.
currency, bruh.
Yeah.
He's just doing anything to like put his name out there.
Build his
Like you
legacy.
said, I like how you said that. Like he likes solving his own problems, like problems that
Create a
he
problem and then solve it. Yep.
he created. Like, there's no reason why, like, to do this, but okay. He just wants people to see his signature. I don't know.
Yeah. So before I even speak on that, let's talk about some of the problems he created and he solved, right? He did the Strait of Hormuz thing, and now we're trying to work through that. Cool. Um,
The
tariffs,
terror.
tariffs, the major one. He did that. They took away TikTok, and they say he brought TikTok back. Remember that too? He did that. Um, I don't know. Those are three that came to mind, but that's just what he
Yeah.
does. That's just what he does. But as in regards to the currency thing, there's actually a law that does not permit any president in office to put their face on any type of currency. So, in my opinion, he's just doing this because that's the closest thing he can do.
Mhm.
When he gets out of office, there's no way they're going to put his name on any currency. So he's doing this while he's in office so that it remains. And a lot of the times, things that presidents do while they're in office, it takes a lot of work to undo it. So he's just trying to build his legacy while he's in office.
I mean, yeah, I think like you said, like, I think is he cares more about what his legacy is going to be
Hmm.
after he's president than rather than doing what's right
Yeah,
during while he's president.
exactly.
That's what it looks like.
That's what it looks like. I agree. I agree. Cool. There's not too much going on in the world right now as far as like outside of Iran and gas prices, but like news and stock market, there's no real earnings that really matter. Tax
Mhm.
day is coming up. Hopefully,
True, true.
if you're watching this, you filed your taxes because I'm pretty sure by the time you watch this, tax day would have passed or you'll have only a few days left. Tax day, I believe, is April 15th. Umar, if you haven't filed your taxes, if you
Why
haven't
are you
filed your
calling me?
taxes, nah, I just like your name, man. If you haven't filed your taxes, make sure you go file it. Or if you're not going to file it, file for an extension or push it to next year. There's a way to do it. But
Mm.
yeah, you got to do something.
Gotcha, gotcha, gotcha.
Anything else?
No, I think that's it. I mean, I think that's it from us with this episode, Investing for Beginners Part 2. So, I mean, we highlighted what you should invest in, how you know if it's a good investment, some of the key financial principles that are important for investing, some fundamentals, metrics that you should look at, technicals. If you didn't know anything about technicals, I believe the insight that Diamond provided is a lot helpful. If you took a screenshot or you want to go back on the episode, definitely look at that. It gives a good idea of what stock movement looks like when
Mhm.
looking at a chart, for
Mhm.
sure. And then obviously, as always, we share some of our personal L's. But yeah, what else? What else do you have, Diamond?
No, I mean that's pretty much it. Like you said, you talked about what we just talked about. Some key takeaways as we close this episode. We talked about all the major things and how to get into investments and all that, but make sure you keep it simple. Understand what you're buying. Make sure you know what you're buying. That's a really pivotal thing because, like we said,
Mhm.
you might buy some trash, and trash is not going to do nothing for your money, but stay down. Um, make sure you stay consistent, think long term, and avoid emotional decisions. And how you avoid emotional decisions is you follow a plan. Make sure you come up with a plan, you follow that plan. When you have a plan for investing, it makes investing a lot easier for you, and it removes the emotional fatigue or decisions that will come up with it, because emotions will play a part. You will panic sell. It's inevitable. You will panic sell. And afterwards, you'll be like, why did I sell this? Why
Why
did
did
I
I
hold
do
this
this?
long?
Yeah.
Or you will panic buy because you'll be caught up in the hype, and you'll be like, dang, this thing is pulling back. Why did I buy at this price? So try to make sure you have a plan and, stick to your plan. But on that note, give us a like if you made it this far. Make sure you're subscribed and you have your notification gang, because, we're still figuring out our posting schedule. But episode 10, it was a pleasure providing you guys with this content. It was a pleasure making this episode for you. And that is the end of this episode of Common Sense, where we're trying to make sense of our sense. We'll catch you on the next one, and episode 20 and episode 100.
Peace. Thank you. Thank you.